Kraft Heinz is officially breaking up. In the investment world, this is a rather interesting development for the simple fact that Kraft Heinz is a name that's been associated to Warren Buffett and his company, Berkshire Hathaway, for a very long time, over a decade now. In this video, I'm going to give some context around the situation, what's happening and why is it happening. And then I'll cover why this is probably one of the biggest mistakes that Warren Buffett has ever made and what types of lessons we can learn from this mistake. So without further ado, let's jump right in. First of all, what are Heinz and Kraft?
For those who don't know, they're two of the largest food and confectionery companies in the world. Heinz owns a plethora of brands. It's a very old company, and they've done many acquisitions over the years. Of course, the most famous is Heinz ketchup, but they also have many types of sauces like mustard and mayo. And if you live in the UK, like I do, you'll be very familiar with Heinz beans.
Kraft is a very similar type of company as Heinz. It's also very old. It also has a very long history of doing many acquisitions. And therefore, it also owns a giant portfolio of consumer brands, very famous consumer brands. If you're from the United States, you'll be very familiar with a lot of these brands on the screen on the right. Heinz used to be a private company until it got bought by Warren Buffett and Berkshire Hathaway in 2013. Warren Buffett wasn't alone in this transaction. He actually partnered with a private equity firm called 3G Capital. So both Warren Buffett's Berkshire Group and 3G Capital combined to buy Heinz for $28 billion. At this point, I think it's relevant to give some more details about 3G Capital. They're run by three Brazilian guys out of New York City, and they have a reputation for being very tough. In the business world, what tough means is that they like to cut costs. And cutting costs often means trimming down the fat. That means closing down unprofitable parts of the business, letting many people go. So it's not always fun to have to deal with these guys. But they had been very good at doing this type of strategy with other acquisitions in the past, and therefore Berkshire Hathaway thought it would be a good idea to combine with these guys. Needless to say that once Heinz was acquired for $28 billion, it was followed by a series of drastic cost-cutting measures. 15% of the company's workforce was let go, and that turned out to be a good thing for Heinz. The company performed pretty well, margins increased, and Heinz became one of the companies in the industry with the highest margins overall. So far, so good. And in 2015, Warren Buffett and 3G Capital once again teamed up in order to buy a different company, this time Kraft. Now, this was a huge merger between two of the biggest and most important companies in the consumer food sector. Merger will create the third largest food and beverage company in North America and the fifth largest food and beverage company in the world. New company would have approximately $28 billion in revenues, with 8 brands worth more than $1 billion and 5 brands worth between $500 million and $1 billion. Kraft shareholders, because yes, Kraft was a public company at the time, Kraft shareholders would have received a special cash dividend of $16.50 per share upon closing, and stock in the combined company representing a 49% stake in the new company. All in all, the transaction cost for the merger between Kraft and Heinz was about $60 billion. Huge transaction. If we look at the share price, we can see that Kraft shares jumped immediately by around 38% right after the announcement of the merger. And actually, the transaction, the merger between Heinz and Kraft was a good thing for shareholders until 27, after which point it wasn't. The acquisition of Kraft was always going to be a disaster, unfortunately for Warren Buffett and 3G Capital. If you look at the company's revenue per share, it actually peaked out in 2014 and then never really recovered. Free cash flow per share was always stagnant as well. Dividends per share also went down. Long term debt also ballooned in 2015 following the merger, and this figure never really recovered to pre merger levels. Now, Kraft and Heinz had always been very acquisitive companies. That was the way that they had always grown, by acquiring promising, growing brands and including them into their established portfolio of brands. And you would think that Berkshire Hathaway and private equity both have similar models of acquiring good companies and letting them run on their own. Except that when you have such a big company as Kraft Heinz had become, you need the acquisitions to actually be substantial and be really big in order to actually move the needle. And so in 2017, Kraft Heinz attempted to acquire Unilever, a company that was much bigger than itself. There was a huge battle, and Unilever was essentially able to deflect this attempt at acquisition. By that point, the market was starting to sour on Kraft Heinz, and in March of 2019 was the final blow here, this giant drop. Kraft Heinz announces an avalanche of bad news. First, it has a pretty terrible earnings report. Second, it writes down the value of a lot of the brands that are on the balance sheet. Basically, a write down is an admission by management that the brands that are in the portfolio aren't worth what the balance sheet currently says. So, this is a huge loss that appears on the earnings statement. And it's an admission by Warren Buffett himself that he overpaid for these brands. And the cherry on the cake is an SEC investigation into the group's accounting practices. This announcement sent the stock down 30% in one day, and the stock price never really recovered. All this sounds like Warren Buffett actually lost a lot of money, but that isn't entirely the case. Warren Buffett, being Warren Buffett, he actually made out pretty well. First, in the initial purchase of Heinz Company, he was able to secure some preferred shares. Preferred shares come at a better cost with a much higher dividend. And so, actually, he made a good deal on those Heinz shares. Altogether, if you look at Berkshire's Hathaway entire experience with first Heinz and then Kraft, they actually were up 60%, including dividends, throughout the entire decade. Actually, if you look at Berkshire's entire experience, first with Heinz and then with Kraft, the company actually was up 60% in the entire time. 60% is not a huge loss, but it does come with a pretty big opportunity cost because the S&P 500 during that same period was up 200 or 300%. But that's okay. Warren Buffett is human. He's going to make mistakes. Everyone that's invested for more than a few months knows that mistakes are part of the game. They're part of the process. It's more about the batting average and never striking out. Nevertheless, such mistakes like these are always a good opportunity for investors like you and me to actually learn from someone else's mistakes, in this case, Warren Buffett himself. The first lesson in this entire debacle is to invest in positive secular trends. Conversely, avoid negative secular trends. Think about it. Everyone is going to make investing mistakes. Usually, that comes from paying too much for a company. If the industry is growing, chances are that the company you're buying is probably going to grow along with it. Maybe even if it loses some market share in the process. It's like swimming with the current. You might not be the fastest swimmer, but at least you're going in the right direction. Investing in industries that are shrinking is a lot more risky. If you make a mistake in that case, chances are you will lose your money for a very long time. If you make a mistake in that case, it's a lot harder to recover, even over the long term. Both Kraft and Heinz sell products that are very processed, ultra processed, refined foods. The reality is that today the consumer is getting healthier and healthier through education and various trends, and they're preferring whole foods like the ones on the left of the screen. That affected the multiple that the market was willing to pay for a company like Kraft Heinz, as the risk is now higher and the potential growth capability of this company is lower. And so that multiple compression that happened over the past decade was one of the reasons why Warren Buffett lost money on this investment. The second important lesson here is to invest in R&D. That's a very short way of saying invest in the business. If you want the best returns overall in the long term, you have to actually invest in the business, innovate, make it better, grow revenues, and grow free cash flow. That's the only way to actually get really good returns over the long term. There are simply no shortcuts. Let's take a look at this article by the Financial Times that I think is really good. The author gives their perspective on the current situation between Kraft and Heinz. I am confident that mergers, breakups, and cost cutting campaigns are secondary sources of shareholder value at best. They can, of course, cause share prices to burst upwards in the short term. Over the long term, though, they can only serve as complements to primary sources of value, such as innovation and high barriers to entry. In the absence of the sale growth that those things create, restructuring and cost control are largely inert. Of course, deal making in particular has great appeal to the people in charge of it. This includes not just the investment bankers who, as with Kraft Heinz, charge fees for both the putting together and the taking apart. CEOs and private equity managers too can get rich by timing their entries and exits. I think the author of the article completely nails it. When it comes to private equity, the entire point of private equity is to buy an asset, make it more efficient in the short term, and then quickly flip it to a buyer that's going to pay a better price now that the numbers look better in the short term. Usually, that ends up being horrible for the company itself for the duration, for the long term. Because at the end of the day, all you're doing is taking future value and using it today. All the future pricing power, all the goodwill of the customers, all of these things that the company would receive in the future is being extracted today. That's why a company like Costco is so good. Instead of doing that, they do the opposite. They deliberately keep their prices low in order to maximize the long-term value of their customers. So, if you make an investment, look whether the company does R&D or not. Phil Fisher, for example, he's notable for having invested in Motorola Solutions, one of his best investments ever. The reason why Motorola has been so competitive over the last 40, 50 years is because this is a company that innovates. Anyways, I digress. The third and final lesson that we can learn from this debacle, probably the most important lesson, is don't overpay. It's quite simple, but so important. The simple fact is that Warren Buffett just overpaid for Kraft. According to this Financial Times article, when Buffett completed the merger between Heinz and Kraft, he valued Kraft at $62 billion. It's really hard to find exact figures of how much Kraft was actually making back then because Kraft was a standalone company and it was more than 10 years ago. But if we trust this website called Macro Trends, we can see that the company was actually making around $2 billion per year in free cash flow. That means Warren Buffett valued the company at a multiple of 23. Yes, at the end of the day, Kraft is a strong company. It's very stable. It never goes out of fashion. People need to eat. Cash flows are pretty stable. It's a strong company, but it wasn't growing that fast, and 23 ended up being way too high of a multiple. Remember that back in 2015, Kraft was valued at $62 billion. Today, the combination of Kraft and Heinz is only worth $32 billion. All right, that's all for this video, and I'll see you in the next one.